If you've ever wondered why one year tech stocks dominate, the next year energy and banks take over, and then suddenly defensive companies start leading the market, it can feel random. But most of the time, it isn't random at all. It's rotation. And rotation usually follows a simple macro map. Instead of thinking about the market as one big machine, think of it as four dials: rates, growth, credit, and inflation. When those dials move, money moves. If you learn how to follow those flows, you stop reacting emotionally and start recognizing patterns. Let's start with the first dial, rates, especially real yields. Real yields are simply interest rates adjusted for inflation. You can think of them as the true price of money. When real yields rise, money becomes more expensive. When they fall, money becomes cheaper. This style mainly controls the battle between growth stocks and value stocks. Growth stocks are companies expected to earn much more in the future. Think software platforms, cloud computing companies, AI innovators, biotech firms developing breakthrough treatments. Investors are paying today for profits that may come 5 or 10 years from now. Value stocks, on the other hand, are companies already generating steady cash flow. Banks, energy producers, insurers, industrial manufacturers, these businesses are making money now. When rates rise, the market becomes less willing to pay high prices for distant profits. Growth stocks often struggle. When rates fall, future profits look more attractive, and growth stocks tend to breathe again. So the memory line is simple. Rates up, growth struggles. Rates down, growth benefits. The second dial is growth momentum. This is the speed of the economy. Are jobs increasing? Is spending strong? Are businesses investing? This dial controls the battle between cyclicals and defensives. Cyclicals are companies that benefit when the economy expands. Airlines, hotels, construction firms, auto manufacturers, luxury goods brands, semiconductor equipment makers. When consumers feel confident and companies invest, cyclicals often get a double boost: higher sales and improving margins. Defensives are companies people rely on regardless of the economy. Grocery chains, utilities, healthcare providers, pharmaceutical firms, consumer staples like food and cleaning products. When growth slows or recession fears rise, investors rotate into these more stable businesses. So here's the second memory line. Growth up, cyclicals win. Growth down, defensives win. The third dial is credit conditions. This one is often underestimated, but it matters enormously. Credit tells us how easy it is for companies to borrow money. When credit is easy, banks lend freely, bond markets are open, and refinancing is smooth. When credit tightens, spreads widen, lenders become cautious, and refinancing risk increases. This dial controls the battle between small caps and large caps. Small-cap companies are typically more dependent on bank loans and domestic financing. Regional retailers, smaller manufacturers, early-stage technology firms, they feel tighter credit quickly. Large-cap companies often have stronger balance sheets and easier access to global bond markets. They can withstand tightening credit conditions better. So the third memory line, credit tight, large caps have the edge. Credit easy, small caps can run. Now we arrive at the fourth dial, inflation. Inflation isn't just high or low. What matters is how it affects business margins and pricing power. This dial controls the battle between companies with pricing power and companies vulnerable to cost pressure. Pricing power means the ability to raise prices without losing customers. Luxury brands, dominant consumer brands, subscription software platforms, patent-protected pharmaceutical firms, these companies can often pass higher costs on to customers. Margin-sensitive businesses struggle more when inflation rises. Restaurants with thin margins, airlines sensitive to fuel prices, retailers competing on price, construction firms facing rising material costs. If costs rise faster than revenue, profits shrink. So the fourth memory line, inflation up, pricing power wins. Inflation down, margin pressure eases. Now, instead of looking at each dial in isolation, let's combine them into possible 2026 scenarios. First scenario, good easing. This is the soft landing story. Inflation cools gradually, the central bank can cut rates without panic, growth slows a little but remains positive, and credit conditions stabilize. In this environment, real yields tend to fall because inflation is improving, not because the economy is collapsing. What usually happens, growth stocks benefit because the discount rate falls. Cyclicals can still perform well if growth remains intact. Small caps may improve as refinancing pressure eases. Margin-sensitive businesses recover as cost pressure declines. In short, good easing often leads to broader participation. More parts of the market can work. Second scenario, bad easing. Here, the central bank cuts rates because something breaks. Growth slows sharply, earnings weaken, credit tightens. Even though rates fall, fear dominates. This is where many investors get confused. Lower rates sound bullish, but if they fall because the economy is deteriorating, markets often shift into risk-off mode. In this scenario, defensives tend to lead. Large-cap, high-quality companies outperform. Small caps struggle under tighter credit. Speculative growth names suffer even though rates are falling. Safety becomes more valuable than upside. Third scenario, sticky inflation. In this case, inflation does not cool enough. The central bank keeps policy tight. Real yields stay high, growth slows gradually under pressure. Here, high multiple growth stocks face headwinds from elevated discount rates. Value-oriented, cash-generating businesses can look relatively more attractive. Companies with strong pricing power outperform margin-sensitive firms. Large caps often hold up better than small caps in a tight credit environment. Each scenario is simply a different configuration of the same four dials. The key is not predicting perfectly, it's identifying which regime is forming. Is inflation trending down? Are unemployment and spending stable? Are credit spreads calm? Are real yields falling for healthy reasons or because fear is rising? Watch those signals, and you'll often see rotation before headlines explain it. The market is not random, it is responsive. When rates move, follow the growth versus value battle. When growth momentum changes, watch cyclicals versus defensives. When credit tightens or loosens, observe small versus large. When inflation shifts, identify who has pricing power. 4 dials, 4 battles, 3 broad scenarios. If you can follow the flow between them, you'll understand why leadership changes, and you'll stop being surprised when it does. Because in markets, money doesn't disappear, it rotates. If you enjoyed this video, like and subscribe. Check out our channel for other great content.